we've started to see a bit of a shift in sentiment as of late. And people are starting to get a little nervous about this market, especially when you look at some of the economic data that we've seen as of late. 1740, what's going to get us there?
Well, you know, the big positive surprise this year has been and will continue to be housing. And housing sale prices are up. Inventory remains relatively low, however, but housing is a big driver of economic growth. It helps consumer confidence. As Adam just said, the consumer is spending, the consumer's balance sheet is pretty good. Let me just
come back with, you know, the fear on housing, though, is that it's not necessarily coming through organic growth. It's a lot of investors that have gone out and purchased properties and are then renting them out. Is that still good news?
I would argue that that's not most of it. I would argue that most of it really is legitimate, real, natural, organic growth buyers for housing. Mm-hmm. And so I think housing will continue to be strong. I think consumer spending is going to continue to be okay. The energy industry is doing well. Autos are doing very well. Aircraft spending is doing very well. So there are lots of things that are working in this economy.
Do you feel like earnings are keeping up?
I think earnings are challenged this quarter, but we did raise taxes. We are cutting spending, as you talked about in the previous segment. A lot of people just mailed a big capital gains tax check to the government within recent weeks. So there is some headwind on the fiscal side. But when all is said and done, I think the economy will continue to muddle through. And as we get further into the year, I think confidence is going to return.
But if we're muddling through, how do we get to 1740 on the S&P?
The same way we've gotten to 1570. We've been muddling through for the last few years now.
And creeping higher.
And creeping higher. Low interest rates, low inflation. Alternatives to stocks are few and far between.
Here's the thing.
What would the PE be about if you're at 1740? Where does that put you?
Basically 15 times $116 of earnings for 2014, because my argument is at the end of 2013, the market's going to be discounting its expectations for 2014.
Here's the thing. I know that you focus on growth. That's really the mandate of the fund. I look at some of your holdings. Apple growth is -5%. Coca-Cola at 7%. Home Depot at 7%. Tiffany, it's 5%. These are all holdings of yours. Not a lot of growth. It's tough to be a growth guy right now.
Well, if you look at it on a quarterly basis, the numbers can always be a little bit below or above the long-term trend, and that's certainly the case with some of these names. But it's a tough environment, no question about it. The economy is not robust, although some sectors of the economy are doing very well.
Where do you find the most growth right now?
Well, the most growth is going to be in probably some of the more expensive stocks out there. You know, on Amazon.com, people might argue there's tremendous growth on the top line, although even that's been moderating.
Pay 180 times earnings? So, you better be a growth guy, not a value guy.
You asked where's the growth, and I'm telling you, so that's a lot of growth. You may not want to pay for that.
Right.
So some of the, you know, a Netflix, people might view that as a high growth name. That's not a name that I own. But so there are growth names out there. There's growth out there. The question is, are those legitimate, good long-term investments?
What I'm also hearing you say, you've got to go stock by stock. You can't just pick a sector. You got to really drill down and know the company.
Yeah, I think that's particularly true today, more so than usual, because there's quite a diversion within each sector as to how some companies are doing versus others.